All right, take it away, Nathan.
So, hello again, everyone. For the third time, I think. Yep, it's the third time. Today, I'm just gonna get straight into it. We're gonna be covering how to choose stocks based on quantitative and qualitative assessment. Clear warning here: I have 40 slides and not many minutes, so I'm gonna be going very, very fast. So, when I choose stocks, I usually choose based on two things. So I go through qualitative assessment, so that would be things like the company's plans for the future, its growth potential, its competitors, things like that. And for quantitative assessment, that would be things like financial statements, revenue, we'll get into that later. So here are the questions I ask myself when I go through my qualitative assessment. First off, before you actually try to invest in anything, do you understand the industry? If not, it's going to be very hard for you to invest. So imagine, like I'm a student, right? If I wanted to invest in a medical company and they specialize in making drugs, I'm going to have no idea what they're talking about when I read their annual report. So there's that to account for. So choose like an easy to understand industry if you're just starting out. Or industry specializing, like you're all teachers, right? Maybe there's a stock for like a teaching website or something like that you would understand better than I would. So I'm just gonna read all of these because we have no time. So you have to account for how easy it is to enter and exit a industry. So that'd be airlines, that's pretty hard to get into, and restaurants, that's pretty easy to get into. So you have to account for that. How many competitors there are? Is the market more fragmented or is it concentrated? Are there any regulations preventing new industries, new competitors to come into the industry? How intense the competition is? Are there many competitors, or is it more like a monopoly where it's like one big company? What's the company's current position? So is it a newcomer into the industry? Is it a challenger, or is it the leader of its industry? What's the revenue structure? We'll be covering that in about 3 slides. What are the company's durable competitive advantages? Durable competitive advantages are advantages you can't buy with money. So imagine if I gave you, how much money is enough to build a company? $1,000 million. And I said, build a soda company that is as well known as Coke. Would you be able to do that? No, because Coke has their brand, right? And that's their durable competitive advantage. That's something money can't buy. Is there still room for company to expand its business? Does everyone know its name? Is it all over the world, or is it just in one country and localized? And what are the risks of going into this industry? So, quantitative assessment. This is things like numbers. There's earning performance, is basically the money they get, so that would be revenue, gross profit, operating expenses, and net income. Financial strength, that's how financially healthy the company is. So that would be interest coverage ratio, cash, account receivables, that's money they can get that people have bought their products and haven't paid them back for it yet. And there's inventory, so that's their stuff. So, since talking about theory would be really, really boring, and it's going to take a long time, I'm going to use the kind of way of teaching we'll have 3 companies each week, and we'll cover specific parts of the qualitative and quantitative assessment each week, and we'll make comparisons for 3 companies through the metrics we're going to be learning about. Another disclaimer, this is what I usually go through when I try to choose a stock. Since this looks really overwhelming and it's going to take a really long time to go through, I put the numbers into graphs so you could better understand it. So, first company of the day, Louis Vuitton, Moet Hennessy. Oh, I said it right this time, SE. So, this is the company that owns Louis Vuitton. The only way I can describe it is as a conglomerate. They own 75 companies, including Louis Vuitton, Kenzo, Marc Jacobs, Dior. You get the idea, I hope. And we'll be, here's their revenue structure. So, to explain this is how they get their revenue, and this is the endpoint. I'll explain this. So, you can see here, this is like bars, their revenue, okay? And this is the amount of money they get from each sector. So, they get 49% of it from fashion leather goods, 20% from selective retailing, that would be companies they own like Sephora, 12% from jewelry, so on and so forth. So then they get their revenue. This revenue has to go through three major costs. That's cost of goods sold, operating expense, and tax. So, once you get your revenue, you're going to have to deduct cost of goods sold from it. Cost of goods sold is basically the money you spend actually making your product. So for Louis Vuitton, Moet Hennessy, I'll just put chart into Louis Vuitton because I don't want to say that over again. Louis Vuitton, that would be like the leather you use to make the bags, or like the lipstick you use to make lipstick from Dior. So you deduct that, and then you get your gross profit. Gross profit has to go through operating expense, and most of this operating expense is SG&A. So SG&A stands for Selling, General, and Administration. It covers things like the ad campaigns, paying your employees, utilities, rent. It also covers things like legal fees if they ever get into legal trouble, or accounting for like they have to account for the money somehow. And after you take out SG&A, you're left with operating income. So operating income, that is also pre-tax income. You get taken out a little bit, but it's so insignificant, we're not going to talk about it. And then they get the tax, and then they get their net income. So, from this graph, I would like for you to observe that SG&A is significantly higher than cost of goods sold, yes? Would you like trying to infer what that means for Louis Vuitton?
Spend more on advertising and
More operational.
Yes, right. Because their main target demographic is the upper middle class, correct?
Yeah.
Yeah, so since their demographic's pretty wide, they have to spend more on advertising for their company than the goods. So here is its revenue structure. It put into, I don't know what the graph name, so I'm going to call it a donut graph. So this is basically the same thing as the revenue structure we just saw. So 48% of it comes from fashion, 20% of it comes from selective retailing, so on and so forth. And this is operating revenue by geographic region. So this tells us how much money they get from each continent or country, yes. So 30% of it comes from Asia, excluding Japan, because Japan's its own little thing. 25% comes from the United States, and 60% of it comes from Europe. This just tells us that it's not too reliant on a specific geographic region to get their money, just in case there's a crisis in that general region. Here's its operating revenue by business segment. This is the same thing as this, except it's in a bar graph, I believe it's called. And the colors correspond, but it wasn't written there, so I just wanted to let you know the first. So you can see here that this would be fashion leather goods, correct? If I remember correctly. And you can see it's slowly been growing. Don't look, that's COVID, so there's like a slight drop. So you can see that all of this has been steadily growing, so no major concerns there. And this is operating revenue by geographic region. You can see that after 2020, Asia has been getting a lot more. They've been getting a lot more revenue from Asia, so you could look into that and say like, oh, Asia is currently preferring luxury products. So, our second company, Hermès. It owns one company, Hermès. No other companies, just that. So it's not very diversified. So if one of the, if Hermès suddenly fails for some reason, they're out. Unlike Louis Vuitton that had like 75 companies, if one of their companies like just fails for some reason, they'll be fine, most likely. So here's its revenue structure. Most of it, 41% of it, comes from other goods and services. 29% of it comes from clothing and accessories, so on and so forth. This is their revenue, gross profit, cost of goods sold. You can see that is 3.7 billion. And then after your gross profit, you deduct SG&A, so that's their marketing, operating income, pre-tax income, tax, net income. So I'd like you to observe on this one. This only comes, SG&A only accounts for 23% of their revenue. But Louis Vuitton's accounted for generally 42%. You want to guess why it's so much like less?
Marketing, they don't have a variety.
because it's not all over the world.
No, it is.
Is it because it's more like middle to high class, but this is more like high class?
Yes, that's exactly it. Because it's a very, very niche market, because there's not very many super, very rich people in the world, Hermès doesn't have to advertise to the masses, because that's not their demographic. No one's gonna buy anyways if they advertise. So since their customers are super rich people, they're gonna be more focused on quality. So you can see here their cost of goods sold is going to be higher than their SG&A. And you can see here because their SG&A is so low, their net income is like a huge chunk. So here's the same donut graph. 41 of their revenue comes from leather goods, clothing, and accessories. This accounts for 29%. Again, they only own one company, so if Hermès fails for some reason, this is all gone. And this is by geographic region. By geographic region, their revenue is actually pretty undiversified. Most of it comes from Asia. 18% comes from Americas. So if Asia suddenly has a crisis, they might be in a little bit more trouble than Louis Vuitton. So here's their revenue structure. It's definitely been growing. So again, it's not labeled there for some reason, but this is fashion leather goods. This is, I forgot. This is clothing and accessories, so on and so forth. You can see that clothing and accessories has grown a lot over the years, and so has everything else. And you can see after 2020, Asia has been eating like a bigger portion of the market, and so has America. So, our last company of today, because there's only 3 companies I prepared, Kering. You may know them as the brand that owns Gucci, Alexander McQueen, Yves Saint Laurent, I think that's how you pronounce it, Balenciaga, and so on and so forth. So, here's the revenue structure. You can see there's a high emphasis on operating expense, but I'll talk on that later. So this is their entire revenue. This is a little bit different as they differentiate by brand and not like type of product. So you can see 50% of it comes from Gucci. So if Gucci fails, half of this company's revenue is just gone. So it's pretty like undiversified. Other houses, those I assume that means other brands. Yves Saint Laurent, and the others are kind of just insignificant. So you can see here that cost of goods sold is it's not very big. But what is big is other operating expenses. That basically just translates to SG&A. Would anyone like to guess why?
To keep it in competition with other brands, they have to keep marketing.
Well, why do they
Do they have to market to everybody?
Yes, because
They have more brands?
no. Louis Vuitton has 75 brands. This only has 12.
But they're on the same level as LV, so keep up. They have to do a lot of marketing to be.
Well, not necessarily. Kering is a little bit lower. It's a little bit more like mass luxury. So since they have a wider demographic, they are going to have to promote more to get it all out there. So there's not much to say other than that. Yeah. So here's its revenue structure in a donut graph. Again, 50% of it's Gucci. If Gucci dies, it's gone. Other houses make up 18%. Everything else is kind of just not very important. In terms of geographic region, like revenue from geographic region, Kering actually does a little better than both LVMH and Hermès, because you can see it's like split up pretty evenly, right? 35%, 27, 23. It's pretty even. So it's not overly reliant on a specific region. So here's the issue. You can see here their revenue has been decreasing a little bit. So you can see that Gucci's been selling a little bit less here, and so has other houses and Yves Saint Laurent. Here's its operating revenue by geographic region. The reason it's doing kind of worse is because North America is buying less and less of it. You can see. And I think that's about it. So, moving on to the comparisons. This is revenue growth comparisons. It is exactly what it sounds. It's comparing the revenue growth. Revenue growth can occur in 2 main ways. Either they raise their prices per unit, or they sell more. It can be also a combination of both, but further analysis is needed to understand why they're selling more or they're increasing their prices. It might be a change in pricing strategy, or it might be change in market demand. It depends. So we can just see here. LVMH has been growing pretty steadily, right? But it's kind of like simmering down a little bit. I don't need to say anything for Hermès, do I? It's just been growing pretty nicely. And Kering has slowly been declining. So that's an issue we'll talk about later. So now we have gross profit margin comparison. So gross profit margin, a gross profit first is the money you get from deducting revenue from taking your revenue and deducting cost of goods sold from it. Margin just means percent. If you see margin, it means percent. Gross profit margin, a declining gross profit margin shows that the company may be reducing its prices to stay competitive. So that would be Gucci, they might be reducing their prices. Strong brands generally have a steady gross profit margin. So because their customers are willing to buy their product without discounted pricing. So you can see here Louis Vuitton, that's been pretty steady. Well, Hermès is a little bit less steady, but it's still going upward, right? And Kering has slowly been decreasing again. We'll touch on why again later. So this is net income growth. Net income growth is what you get from taking the revenue and taking the three main costs, so that the cost of goods sold, operating expense, and taxes. So you can see here that again Louis Vuitton is kind of evening out a little bit, decreasing a little bit. Look, Hermès is just going up. I don't know what else to say for that. And Kering has kind of steeply been going down actually. So here's net profit margin comparison. Net profit is again the thing you get from taking your revenue and taking out the three main costs. So the gross profit margin directly affects the net profit margin. It reflects the profitability after covering the cost of goods sold. So if you have a high if you have a high fixed cost, for example operating expense or SG&A, and you have a lower revenue, you're gonna get more affected by that, right? So it'll reflect that. A declining GPM can reduce NPM due to the loss of what I just said. But a higher GPM can boost the NPMs because you have more revenue and your fixed costs stay the same, and so you're gonna get more money, right? And then you're gonna have more money to spend on other expenses. So LVMH, again, don't really look at 2020 that much. It's kind of an off year. So you can see that it's boosted back up, but it's also slowly declining. Hermès is going up, but it's having a slight downward trend. And Kering, it dropped. That's all I can say. Because they dropped because their revenue lessened. I'll explain that later. Actually, that seems like a good part to say for later. Interest coverage. Interest coverage is basically how many years the company can comfortably pay off its interest with the current earnings. So a high interest coverage just means that the company is doing well financially, but a lower interest coverage just means that it's having trouble managing its debt a little bit. So LVMH, you can see it was really high at some point, but it's dropped. And now it's at 21. That's not bad by any means. It's actually pretty good. Not much else to say. Hermès is at 103. So they can cover their interest for 103 years in total. And Kering's at 8. It's not bad, but it's also not the best. So it's something to keep in mind if you're going to invest. Because what if they get into a crisis and then they can't pay off their interest? So this is price versus earnings. I just put the price graph over the earnings graph. The price is this dark line here, and the earnings is this light blue line, okay? So can you kind of see how the price and the earnings kind of follow each other? And you can see here there's a gap, right? This gap is closed. Why? Because the earnings, if the earnings are high and the price is low, people are going to be like, oh, this is amazing stuff, why am I not buying this? So they'll buy, and the price will come up to meet the earnings. But if the earnings are low and the price is high, people are going to be like, oh, it's declining. I don't want the stock anymore. And they're going to sell, and then the price will come down to meet the earnings. Or it can be a combination of both. That can also happen. So this gap needs to close up now. So you can see there's a big gap here, and it closed in 2023 around there. So we can take an example from currently anyways. This is last 12 months, by the way. You can see there's a big gap here, right? Earnings only went down 7.5% from the peak in 2023, but the price went down by 35%. So that's like a pretty unproportionate decrease, right? So you can see this as either a opportunity or it could be a loss. So again, there's two ways this gap can close. You can either, one, the earnings stay the same in the future or they increase in the future, and the price comes up to meet the earnings. Or two, the earnings continue to decrease, and the price will stay the same and the earnings will just come down to meet it. So the reason that the price is dropping so drastically right now is news headlines. I'll read these to you. LVMH continues to be hit by luxury sector challenges. LVMH earnings were a bloodbath, but CFO is convinced becoming more affordable isn't the answer. And LVMH misses expectations as China flags. Would you like to infer how this affects the price? Like what people are thinking when they're selling it?
I need to get out. It's not going well.
Yes, exactly. You can see that the luxury sector is facing a challenge. Like right now, China's economy isn't doing well, and they're a big part of Asia, and most of their 30% of their revenue comes from Asia, right? So you can see here, LVMH misses expectations as China flags. So people are panicking, oh no, they're not selling in China anymore. I don't want the stock anymore. So they're kind of overreacting a little bit. So yeah. So this is LVMH's PE ratio. If you remember that from last week, hi Mr. Mitch.
Hello.
So its PE ratio currently is 20.87. That is as low as it was when it was COVID. So again, you can either see this as an opportunity or a loss. If earnings continue to stay the same, you'd be getting it really dirt cheap. But if the earnings continue to go down, you'd be losing a lot of capital gain as well. So here's the price versus earnings graph for earnings. You can see, again, they generally follow each other, right? And right now there's just a little gap, but it's not huge. Earnings are actually up by 3%, but the price is going down. Why would that be?
Too much stuff. Too much stuff for themselves.
Too much stock.
Yeah.
Extra stock, too many bags not being sold.
Unable to sell, prices are down or on sale.
Well, no, because the earnings are actually going up, right? That even means they're actually selling more, or they're. So that could be the case, right? I'll show you. So, earnings contradicts luxury sector downturn with double-digit revenue growth. Earnings maintains its growth in Q3 2024 despite its revenue luxury sector, and earnings continues to outshine rivals with Q3 sales up by 11.3%. The thing is, here's the thing: luxury sector downturn. That's what earnings is a part of. So while it's growing, people are still unsure, ooh, I still might be affected. So people are starting to sell because they're not sure. But but it doesn't really look that way, as you can tell from these titles. So sometimes the market can be a little bit irrational. Is that the word? Yeah. So here's Hermès' PE ratio. Hermès. I keep pronouncing it wrong. Right now it's at a 47.6. It wasn't as low as it was at COVID. Actually, it's kind of pretty moderate for Hermès, but it also reached 70 at one point. So there's also that. But right now it's kind of expensive, but not very, compared to itself, anyways. And here is Kering's price and versus earnings. You can see there's no gap here. People were right; they expected the earnings to go down, and it did. So you can see here that at some point, if I covered this graph, you would be able to see that there's a huge gap here. So it could have gone either way. The earnings could have continued to go up, or the scenario that actually happened, the earnings went down and they followed the graph. So earnings are down by 42%, and price is down by 68% since 2022. Its peak in 2022. So here's the reason why its earnings are so bad. Kering projects a 47% operating income drop in 2024. Gucci revenue dies by 25%. Kering warns of weakest annual profit in years, and Kering warns on profits after sale and sales fall 16% in Q3. So you can see here, since Gucci is like 50% of their revenue, right? Do you remember that? If Gucci revenue dies by 25%, that's not good for them. That's half their revenue, and it's like a quarter of their half of their revenue. It's gone. So that's why their earnings have been so bad like recently, and so the price has like kind of like in the middle. So here's its PE ratio. It's lower than it was at COVID, but as you saw with their earnings, they're also not doing very well, so it's kind of like reasonable. It's at 12.4. I think at COVID it was 21. So while the PE ratio is low, you also have to account for if it's just going to continue going downhill, or if you think it's like bottoming out and coming back up. So here's a quick summary table. We have no minutes left actually, but we'll just finish this real quick. Here's the summary table. LVMH's market sector, that's luxury, just normal luxury. Hermès is for the super rich people, so super luxury. And Kering is mass luxury, so it's kind of like for just the general middle class. LVMH has 75 brands under its belt. Hermès has only 1, and Kering has 12. LVMH's consumer price sensitivity is pretty low because they're marketing to the upper middle class, right? If there's a crisis going on, they're not as affected as maybe like the normal middle class. So Kering's is somewhat low because of that. And Hermès, they're not affected. They're super rich. They can buy whatever they want. LVMH, so their revenue is steadily growing, but they're experiencing a slight decline currently. Hermès is steadily growing, and Kering is steadily declining. LVMH has an interest coverage of 21 years. Hermès has an interest coverage of 103, and Kering has 9. LVMH, its share price currently has dropped 35% from its peak. Hermès has dropped 17% from its peak, and Kering has dropped 74% from its peak. LVMH's PE ratio is currently at 21. Its historical average is at 25, so it's actually kind of like a little bit less than its average, but not that much. Hermès, its current is 47. Its average is 45, so it's actually like a little bit above. And Kering, its current is 12, and its historical average is 25. So it's like way down, so it's like 2 times. So with all of this in mind, which would you pick, but why? And why? But let me lay this out for you first. Kering is super cheap right now. Its PE is dirt cheap. But its earnings are also not looking very good. Hermès is doing super well. It's fine. But also the PE is 47. LVMH is just kind of in the middle. So I'd like to let you make your choice. Which would you choose and why?
Maybe LVMH because it's less risky than the other two.
Yeah.
That's how I might feel about it.
That's fair. That's fair.
Yeah.
Kering because it's low. Buy low, sell high.
That can also be a thing, but you also have to consider there's a crisis going on right now, and that may not be resolved for another 3-4 years. So you could lose it. Right now, China's been going through a lot of economic stress.
I would go for LV too.
LVMH. Yeah.
Is everyone?
I'll take that Hermès.
It's really expensive, but that's also fair. It's a really big company.
And if it's gone, means all the stock's gone.
To be fair, Hermès is very unlikely to fail because they're selling to a very niche demographic that's willing to pay. Also, this fun fact: Hermès has the prettiest crafts I've ever seen since starting. They're just so cute. Does anyone else want to share their opinion, what they would like to quotations because we're not actually using money right now.
If you come and think about Gucci, when you see the geography of other countries, it's balanced. It's not all for Asia.
Yeah.
That would be better rather than going for LV. 50% is Asia. So if Asia has a market down, we are gone.
Yeah, that's true. It depends on how you look at it.
So they are very pros and cons.
So I believe we are all currently late for class by 5 minutes. Thank you. Do you have any really quick questions? Because I really want to know who won my debate.
It was amazing.
Good job, ladies.